Good afternoon. This is Ken Long at Tortoise Capital with a review of a turbo and core case study from December 1st, 2017. This one's really important. It illustrates the concept of turbo and core extremely well. It shows how you can exploit surprise news stories with volatility trading. It's consistent with our intraday principle of find the mover, exploit the mover, and then in the plan, prepare, execute, and assess model, we place an emphasis on the preparation. The better prepared we are, the luckier we get. So let's go into the case study. On the morning of December 1st, the market was overbought. It had been vulnerable to downside volatility spikes in the previous week, meaning that the surprise moves were all to the downside against the primary trend. Our short-term risk index is an indicator which was showing that large adverse volatility spikes would not be surprising. In other words, the market was ripe for exactly that kind of system shock. The market opened normally, and we conducted routine intraday trading. In the morning, there was a fake news release from ABC which rocked the market, and all the instruments correlated with it, beginning with the most volatile trading instruments, began to trend wildly. This was the news that erroneously reported that General Flynn had said that the candidate Trump had directed him to contact the Russians. That was false news. Nevertheless, the market really began to melt down because of the potential impact on the Trump administration and therefore the political economic environment. All of the intraday tripwires that we had prepared for XIV, that's the inverse volatility ETF, which goes up when the market's going up generally, and which is the first to fail when a system shock occurs as hedgers begin to put on new positions based on volatility. So these tripwires failed and indicated that an abnormal intraday move may have just started that was contrary to the primary upward trend. So we entered according to our rules, and we managed our positions in the routine way to exploit what turned out to be a runaway bearish move. Throughout the morning and early afternoon, we continued to frame and trade rebound trades that were counter-reactions to the initial downward spike. And we framed and managed our trades using our indicators to have managed reward to risk ratios. Thanks for bearing with me. So this YouTube video here is the market commentary from the night before, which summarized the posture of the market that made it especially vulnerable to these kinds of volatility spikes. If you go to that link, you can listen to it. It's about 15 minutes. The quick summary of those was that we had had a market, this is daily, that had been grinding up. The slope of the 30-period regression line was up. It had been accelerating up, as you see by the parabolic regression line. The actual move of that day, you can see this enormous sharp volatility spike and then a recovery rebound trade. That's what made the trade so lucrative. The risk Z indicator for that day had just come from making a double bottom to the downside where volatility was sharp and had just come back to the zero line. This is a natural place for it to collapse further, and if you get this kind of volatility spike down, that could translate to an 8 to 10% loss in the S&P and more for those more volatile instruments that track the S&P. So it had just crept into the green, and that puts the market at a critical state in terms of volatility because sharp downward moves are not surprising, and yet there's more room to grind northward like this. This is about a 5% move it turned out in the S&P. And so this is at a market at critical state where you have a strong possibility for abnormally sized moves in either direction. That's what makes it a trade. In terms of calibrating our expectations, the intraday range percentages on the VIX. The average move of the previous 30 days have been 3.5%. The average plus one standard deviation was 5.8%. And the single biggest intraday move just in the last 30 days was 12.75%. Compared to the last 200 days, all the numbers you can see there. The worst adverse, or the worst intraday move, or the largest intraday move, actually, that's the best one for traders, was over 14%. So VXX and its partner XIV turn out to be outstanding opportunistic plays for volatility spikes. The S&P market health check on the dailies, you can see that going into the day, the market had been at an extreme condition. It had done a Z3 pinch. The slope of the 30-period regression line had begun to strengthen. We were 5 days into another nice move out of this consolidation zone. It had been pushing the boundaries of the Z3 Bollinger Band consistently, and we had large range days, so this is prime time for either a runaway move to the north or sharp moves back to the Bollinger Band mean, and that's what we have here. The MACD histogram, or the PPO, showed the market was above the zero line, had just made a crossover, and so the long side was favored, but we also recognize that because it had already stretched out here for 3 or 4 days, that being at Z3 like this, we were vulnerable to sudden sharp pullbacks. And we'd actually seen, you can see the length of these large spikes to the downside. In every case, there was a recovery. So we would not be surprised to see a sudden volatility spike down and then a recovery back to fair value, as institutional money would see that as buying on dip opportunities and wanting to get this strong move at a discount. And that's essentially what we saw that day. So market gap down, sold off in the usual way. This entry short at 116.50 is part of our hybrid frog entry. That's a routine entry to the downside. There was a fractional gain of about an R when the RL10 rolled back up and there was no further failure, and the MACD histogram line began to enter its own Bollinger Band here at below the zero line. This was a natural place to take a short. We missed that move, but this is sort of a routine move. Failure to fail further, and now you can see the slowly improving MACD histogram line has now crossed over its own Bollinger Band mean. This is a 30-period one standard deviation on the 1035 MACD histogram. This is a reasonable place to get tentative long side entries in up markets. So we get long inside here, suffered a little bit, but then got into the money quickly. Had a nice move that got back to the opening resistance, but did not close the gap. And so as this rolls over and begins to enter the river again, this is a natural place to cash a nice move from 116 to 116.75 on a 50-cent risk. So that's about 1.5 R. This signal line did not fail below the zero line, so a crossover back to the upside gives us this entry, again with a 50-cent stop. We're down around in here, and we are able to stay into that trade as long as the MACD histogram is improving, all above the zero line. We're able to ride the storm out, and going in towards 11, we're up at 117, so we're almost 2R in hand. That goes up to 117.5, rolls back over now. We now have the crossover to the downside, re-entering the river, a natural place to cash a couple R there. From that peak at 117.50, this is an afternoon frog entry, and so we get a collapse here, and this was where the news announcement occurred, and this began to drop like a rock, so immediately shorted. And this is the signal line coming through the Bollinger Band River on the MACD histogram. So that's a signal to get short. Our directional bias is now to the short side when that signal line crosses below the dash line. And so we get a routine entry here. This 117 short gets covered at 115, so that's 4R. and then immediately fails, and then when it fails below the real body, we get short. It fails more, we get short again when it collapses below here. These are 1 minute charts. Get a third position on based on money management. Now we get 3 positions in. We don't tolerate much rebound from this. Is a cover at about 108. So short from 115, 113, and 111, covered at 108. That's $7, $5, and $3. That's $14 per share on 50-cent risk. I'll let you do the math. Miss the long side. When it starts rolling over here again, we get short. Get a second position short. We're below that zero line, so I'm not. I wish I was better and I could get that. So the short, the second short, the third short, when it makes a new low of the day, a spike down and starts to recover. When it comes back to the RL10, we cash all 3. It has just a tiny more of a bounce. Not interested in the long side at all because of the decisive nature of the downward slope here in MACD histogram. It rolls over. We get a 1, 2, 3 re-entry. A second position short, so this is at short at 108.5, short at 105, covering down around 103. You can see that this big spike, at 105, so this big spike caused us to stop and reverse. Now we had this crossover, re-entered the Bollinger Band River in the MACD histogram. This was a double range stat move, so this is a move intraday from about 117 to 103, so that's $14 on 111. That's about a 14% move. So that was the largest move that we'd seen in the last 200 days. And then after this sort of decay of volatility, that felt like it was done. We took some of that market's money, got long, covered in the usual way, failed to fall further. Now we've got a crossover to the upside after this nice recovery gain. Long. A second long, long, covered, now short, scratch, long, and then getting, so now we're long from about 108, and this is up around 112. That move continues. We cash at 112, taking a break for the smoke to settle after lunch. This is a breakout to the upside right here. MACD histogram above the zero line. Cross over the upside long. Now we're just getting bites. Doesn't fail further. Next crossover to the upside here. Long and cash. We're still above the zero line. Long, then cash. And that's a pretty good day at work. So the central ideas here are the idea of find the mover, exploit the mover, be prepared in your moves, understand market conditions and have expectations for the size of moves, know where you are inside the larger market regime and what those intraday moves can be, have an estimate of the difference between normal, abnormal, and exceptional moves, and then manage your positions using standard elements of risk. The more unusual the day, the more important it is to rely on your trading norms for position sizing and money management. Thank you for your kind attention, and this combination of the RLCO framework and the MACD histogram and the use of pinch and stretch conditions for swing and day trading, this is the best collection of ideas that we've had in probably 20 years, and I'm eager to share it with you, and I hope that it fits in with your skill set and your desire to trade well. So take good care, and we'll see you in the chat room.